If you want to find the companies building the multi-billion-dollar future of humanoid robots, well, you really shouldn't look in a pristine, white-walled Silicon Valley laboratory.
No, you definitely shouldn't. That's a huge misconception.
Right. If you really want to see the physical building blocks of our robotic future, you actually need to look inside a gritty, heavy machinery automotive plant in Germany.
Exactly.
A plant carrying over 5 billion euros in debt, by the way.
It is a phenomenal disconnect, honestly, between popular imagination and industrial reality.
It's wild.
We are looking at a scenario where legacy manufacturers, companies that have spent the last 50 years perfecting the greasy, heavy internal workings of traditional vehicles, are quietly positioning themselves as the indispensable foundation of the humanoid robotics industry.
And that is exactly our mission for this deep dive.
Right.
We are taking the sources you shared with us and unpacking how traditional auto part manufacturers are, like secretly becoming the absolute backbone of the entire humanoid robot movement.
It's a massive shift.
It really is.
Yeah.
And we're also going to look at why the global financial markets are totally, completely missing the boat on this right now.
Oh, they are completely blind to it.
Yeah, we have market caps, hidden partnerships, and some incredibly weird financial projections to get through. So what does this all mean?
Right.
Like, how do we even begin to track an industrial shift this massive?
To really grasp the scale of this, we have to look at the primary case study provided in our notes. There is a company called Schaeffler.
Schaeffler.
Right. Now, for anyone outside the automotive manufacturing bubble, that might not be a recognizable name at all.
I certainly hadn't heard of them before this.
Most people haven't, but they are an absolute titan in the European auto sector. If we want to understand the mechanics of how a legacy car company transforms into a robot company, Schaeffler is the ideal example.
Okay, let's lay out the actual numbers from the source, because they paint a very specific, almost contradictory picture of who Schaeffler is today.
They really do.
We are looking at a company with a market cap of roughly 7.47 billion euros. But they are carrying a massive load, about 5.14 billion euros in debt.
Which is a huge factor.
Right. So if you look at their enterprise value, which is the actual total cost if someone were to buy the company outright, it is significantly higher than that 7.4 billion.
Exactly.
They are a heavy, traditional industrial giant. But then the source drops a statistic that absolutely blew my mind.
The partnership number.
Yes. Schaeffler is currently working in secret with 45 different humanoid robotics players. 45.
It's staggering.
The author literally calls this an extremely insane number. And I have to agree. I mean, I could maybe name 3 or 4 robotics companies off the top of my head.
It highlights the sheer invisible breadth of their influence. You know, they are not just partnering with 1 or 2 highly publicized tech darlings in California.
Right.
They are supplying the entire ecosystem, from the famous giants everyone has seen on video all the way down to stealth startups that don't even have a public website yet.
Okay, let's unpack this, because my brain is having a hard time reconciling these 2 completely different worlds.
How so?
Well, it's like discovering the people making the hinges for your kitchen cabinets are secretly supplying the joints for Iron Man.
That is a remarkably accurate analogy.
Thanks, but I still have a mental block here. How is a traditional car parts company, a company burdened with billions in legacy debt, actually relevant to cutting-edge humanoid robotics?
It comes down to manufacturing reality.
Like, what are they bringing to the table that the heavily funded tech startup couldn't just invent or, 3D print in their own lab?
To answer that, we have to talk about the concept of a BOM, or a bill of materials.
Okay, a BOM.
Right. When you manufacture any complex machine, the bill of materials is essentially your master recipe. It is a comprehensive list of every single physical component, every screw, and every microchip required to make the final product.
Got it.
So let's break down the physical anatomy of a humanoid robot according to our source data. What does a robot actually need to walk, lift a box, and interact with the physical world?
Well, it needs joints, it needs a brain, it needs power.
Right, but physically, what does that translate to? It needs bearings to allow its joints to pivot smoothly under heavy loads.
So bearings.
It needs gearboxes to transmit power efficiently without snapping. It requires highly sensitive sensors and electronic control units.
ECU.
Exactly, ECUs to process spatial data in real time. It needs actuators. And it needs power electronics to manage the massive flow of electricity to all these moving parts without overheating.
And Schaeffler makes all of that for cars already.
They do more than just make them. They have spent over half a century figuring out how to manufacture these exact components incredibly cheaply, with zero fail rates, and at a massive global scale.
Which is really hard to do.
It's the one thing Silicon Valley struggles with the most: mass physical manufacturing. Think about an actuator. In a heavy SUV, the power steering system uses an actuator.
Okay.
It takes the tiny, effortless movement of your steering wheel and translates it into the massive physical force needed to turn 2 tons of metal and rubber.
Wow, right.
A humanoid robot needs that exact same translation of digital signal to physical force to, say, bend its knee while carrying a heavy load. The physics are identical.
That makes total sense.
And the source estimates that if you look at a humanoid robot, the components that Schaeffler covers can make up roughly 50% of the robot's entire physical makeup.
Wait, really?
Half of the entire bill of materials.
Half the robot. That is a staggering visual. So they aren't just supplying a few random bolts. They are essentially manufacturing the entire musculoskeletal system of these humanoids.
Exactly. But this is where the narrative in the sources shifts from the physical hardware to the financial projections, and things get very strange.
How so?
Well, Schaeffler is officially targeting a 10% market share of all these humanoid components globally.
Okay, 10% of a massive future market. Sounds reasonable.
However, their revenue projections for this sector are almost laughably modest. They are only projecting a few $100 million in revenue from this robotics division by the year 2030.
Wait, if they were supplying 45 companies and making 50% of the physical robot, how is that only worth a few $100 million a few years from now?
What's fascinating here is the author's specific note on that revenue projection. The source describes that estimate as extremely sandbagged.
Sandbag?
Yes. In corporate finance, sandbagging is a deliberate strategy where a company intentionally downplays its future earnings or growth potential.
Ah,
They set the bar artificially low so that they can easily step over it and beat those expectations later.
right. Under promise so you can over-deliver to your shareholders.
Precisely.
But why sandbag it so extremely? I mean, look at the contrast here. You have the Elon Musk's vision for the humanoid market, specifically with the Tesla Optimus program.
Oh, it's night and day.
He is standing on stages talking about a future where there are billions of humanoid robots on Earth. He is projecting a total addressable market that is almost incomprehensibly massive.
Trillions of dollars in theory.
Yeah. Yet here is Schaeffler, who stands to make the actual physical parts for these machines, acting like this is just going to be a nice little side project by 2030.
It is a massive clash of corporate cultures, absolutely. The venture capital world operates on hype, while the legacy industrial world operates on risk mitigation.
But it raises a really critical question for me. Why would a company with over 5 billion euros in debt actively downplay their future revenue in what might be the biggest booming sector of the century?
This is the core tension.
Because if I run a company and I owe 5 billion euros, I am shouting about my new multi-billion-dollar robotics empire to anyone who will listen, just to get my stock price up.
Sure, that's the tech playbook.
Are they just being overly cautious, or is there a deeper structural reason for this extreme sandbagging?
It goes right back to that 5 billion euros in debt. When you carry that much legacy debt, your primary audience isn't the retail investor trading on a smartphone app.
Who is it then?
Your audience is the bondholders, the institutional lenders, and the conservative banking sector. Those entities do not care about futuristic hype. They value extreme predictability, stability, and cash flow to service that debt.
Oh, I see.
If Schaeffler pivots too hard publicly and says, we are a robotics company now, and the humanoid market takes slightly longer to mature than Elon Musk predicts.
They look irresponsible.
Exactly. Schaeffler risks looking like they're gambling with the bank's money. They could lose credibility with the financial institutions keeping them afloat.
That is a brutal tightrope to walk.
It is. They have to secure these partnerships, all 45 of them, in total secrecy, while presenting a boring, totally stable, traditional face to the public credit markets.
So they're playing a very quiet, long game, protecting their baseline while secretly building the future.
Exactly.
But the sources don't just focus on Europe. They broaden the map significantly.
They do. It's a global phenomenon.
Right. If Schaeffler is the European anchor, the source mentions other massive players doing the exact same thing globally. There's a Japanese company called Nabtesco and a Chinese manufacturer called Sanhua.
Yes, Sanhua is a major player.
And the notes directly link Sanhua to supplying components for Tesla's Optimus robot.
Right, and Nabtesco is a fantastic example, too. You'll find them on the Tokyo Exchange under ticker 6268.
Okay.
They are a massive industrial player heavily focused on manufacturing precision robotic joints and reduction gears.
So we have this massive established global ecosystem of legacy hardware companies ready to build the future.
The infrastructure's already there.
But here is the glaring contradiction I can't get past. If these companies are physically building the most exciting technology of the next decade, why are they all trading at such low, boring valuations?
It's the multi-billion-dollar question.
Like, why isn't Wall Street throwing money at them?
If we connect this to the bigger picture, we run straight into a concept the source describes as the drag from auto.
The drag from auto.
This is the core reason the financial markets are completely missing the boat. Right now, for companies like Schaeffler, Nabtesco, and Sanhua, humanoid robotics is an incredibly exciting, futuristic sector.
Right.
But financially, it likely accounts for roughly 1% of their overall revenue figures today.
Oh, wow. Just 1%.
Barely a blip. The other 99% of their income is deeply, fundamentally tied to the traditional automotive market.
Which, to put it mildly, is not exactly a high-growth, explosive sector right now.
Far from it. The global automotive market is slow-moving, heavily cyclical, and currently facing massive, painful transitions of its own regarding electric vehicles.
So they are weighed down.
Heavily. Think about how Wall Street models value. An analyst looks at a spreadsheet for one of these companies and they don't see a futuristic robotics play.
They just see car parts.
They see a legacy car parts manufacturer struggling with a 2% drop in global auto sales. That 99% legacy business is effectively acting like a massive anchor, dragging their stock prices down.
So if you're listening to this and looking at your own portfolio right now, you might see these legacy auto companies and think they're a dying breed.
Exactly.
But what the market is pricing as a struggling car company might actually be a heavily discounted robotics giant in disguise.
The markets simply aren't pricing in the robotics exposure yet because the current revenue isn't large enough to offset the sluggishness of their core automotive business.
The math doesn't let the robotics side shine.
It's completely buried.
It is the ultimate disguise.
Yes.
They are hidden by their own massive legacy businesses. But that begs the question. What is the catalyst?
What changes the math?
Right. What is it actually going to take for these companies to shake off that auto drag and get recognized by the broader market for the absolute gold mine of robotics potential they are sitting on?
For that, the source points us to a highly specific forecast. There is a quote included from the chairman of TSM, Taiwan Semiconductor Manufacturing.
A heavy hitter.
Absolutely. He cites a fascinating technological convergence. He believes that humanoids combined with AI auto, essentially the integration of advanced artificial intelligence into both next-generation vehicles and robotics simultaneously, will be the catalyst.
Okay.
The chairman predicts that this dual thrust of AI hardware will act as a major growth vector, specifically past the year 2027.
2027.
That is the horizon line for when this fundamentally shifts the automotive players' valuations.
Okay, 2027. But here's where it gets really interesting, because the source makes a brilliant point about what has to happen between now and that 2027 catalyst.
It's not just a waiting game.
No. The hardware world is sitting there. They have the factories, they have the capacity, but they're waiting for something very specific.
Yeah.
The source calls it a ChatGPT or Anthropic breakout downstream leader.
It is a critical distinction. Hardware rarely creates its own demand out of thin air. It needs software to give it a purpose.
Let's think about this for a second, because the parallel to AI is perfect.
It really is.
Before ChatGPT launched, artificial intelligence was kind of abstract for most people. It's a novelty. Then suddenly, OpenAI releases this clean, highly functional interface, and overnight, every single company on Earth realizes they need AI right now.
And what did they actually need to run that AI?
They needed the computing power.
Yeah.
It triggered a hardware gold rush for NVIDIA chips.
Yes. The software breakthrough created an instantaneous, massive demand for physical hardware.
And the source is arguing, we're waiting for that exact same moment in the humanoid space.
Exactly.
We have the physical parts ready to go. Schaeffler has the actuators. Nabtesco has the precision joints. But what are they waiting for?
A brain.
Yes. They are waiting for a software company, an AI leader, to release a robot brain that is so undeniably useful, so revolutionary, that every warehouse manager, every hospital administrator, and eventually every household suddenly demands a physical robot.
That's the tipping point.
We need a software moment so undeniably powerful that it instantly creates a tidal wave of demand for the physical hardware these auto companies are quietly stockpiling the capacity to build.
That is the exact mechanism of the catalyst. Software creates the demand, hardware fulfills it.
Right.
But this brings us to a harsh reality about how financial markets actually operate today. If this massive, software-driven humanoid explosion is slated for past 2027,
Which is years away.
what is the market staring at right now? Markets are notoriously short-sighted. They cannot look 3 years ahead when there is money to be made this quarter.
So where is the market's attention right now, if not on 2027?
According to the source, investors today are completely distracted by immediate upside from supply chain bottlenecks.
Like what?
They are looking at severe short-term shortages in memory chips or components like MLCCs,
MLCCs. What are those?
multi-layer ceramic capacitors.
That sounds incredibly dry.
They are tiny, incredibly unglamorous components used to regulate power in almost all modern electronics, from your phone to an electric vehicle. Because there are severe shortages of these basic components today, the market is hyper-focused on who is making a profit off MLCCs this financial quarter.
Chasing the immediate cash.
Analysts are fighting over pennies today, rather than looking at who is going to completely dominate the 50% bill of materials for humanoids 3 years from now. They are missing the forest for the trees.
It is wild to think that the entire framework for a new species of machine is being built right next door, and Wall Street is too busy looking at ceramic capacitors to notice.
It happens more often than you'd think.
But I have to push back on this whole premise, because there is a massive assumption baked into this hardware supremacy idea.
What's the assumption?
The assumption is that a robot in 2027 is going to look and function like a car. If we're waiting 3 or more years for this massive breakout and the software is still evolving at breakneck speed, what if the physical architecture of these robots completely changes?
That is the big unknown.
Right. We are sitting here assuming a robot needs gearboxes and bearings and traditional actuators. But what if some genius engineer figures out a way to build a functional humanoid using synthetic muscles?
Or pneumatics.
Yeah. Or localized magnetic fields that completely bypass traditional automotive parts. If the physical architecture of robots is still changing this rapidly, isn't it highly likely that the parts we think make up a 50% imbobome today will be totally obsolete tomorrow?
It's entirely possible.
I mean, this feels like a massive, terrifying gamble for these legacy companies.
That is a phenomenal point, and frankly, it is a massive risk. You are entirely right to challenge that assumption, and the source actually acknowledges this exact vulnerability.
They do.
Yes, the text notes that as different humanoid architectures evolve, we are absolutely going to see random, highly unexpected winners emerge.
Interesting.
The notes refer to this as an HBM-type surprise.
An HBM-type surprise. Explain the mechanics of that. What does that actually look like in practice?
It refers to a sudden, paradigm-shifting event in hardware architecture that crowns an unexpected winner. HBM stands for high bandwidth memory.
Okay.
For years, HBM was a relatively niche, expensive memory architecture. It wasn't the industry standard for general computing.
So nobody paid attention to it.
Exactly. But when AI models suddenly became the dominant software, they required massive, instantaneous data throughput that traditional memory just couldn't handle.
So HBM was the only solution.
Suddenly, HBM became the absolute bottleneck for the entire AI industry. The very few companies that had been quietly manufacturing this niche product saw their valuations skyrocket overnight.
Wow.
It was a surprise winner dictated entirely by a sudden evolution in software architecture.
So a shift in the wind completely changed who the kingmaker was.
Exactly. And the source is warning us that while Schaeffler and Nabtesco look perfectly, flawlessly positioned today with their gearboxes and actuators, the humanoid space is so incredibly nascent.
It's barely begun.
Right. An architectural shift, like the synthetic muscles you mentioned, could suddenly render traditional gears obsolete and crown some obscure, unknown chemical manufacturer as the new king of the robotics supply chain.
So it really is a high-stakes gamble for these legacy companies.
Very much so. They are betting their existing manufacturing prowess will dictate the future design of robots, simply because it is the most economically viable way to build them at scale.
That makes a lot of sense. So to synthesize this whole wild journey we have been on today, we started with the glossy illusion of the pristine Silicon Valley robot lab, and we shattered it by looking at a 7.4 billion euro German auto parts maker burdened with heavy legacy debt.
It's quite the contrast.
We uncovered their secret empire, supplying 45 different robotics companies and holding the manufacturing keys to 50% of a robot's physical makeup.
Hidden in plain sight.
We unpacked the massive disconnect between their sandbagged, conservative financial projections designed to keep bondholders happy and the wild multi-billion unit hype of Elon Musk's vision.
Two very different worlds.
Definitely. We mapped out how this massive industrial potential is currently disguised by the sluggish auto drag, keeping stock prices low while Wall Street squabbles over short-term capacitor shortages.
The MLCC distraction.
Right. And finally, we looked at how the entire heavy industry is holding its breath, waiting for a ChatGPT-style software moment to light the fuse past 2027, assuming, of course, that the physical architecture of the robots doesn't completely change the rules of the game before they get there.
It truly is a masterclass in how massive technological shifts actually occur in the real world.
It's fascinating.
It doesn't happen in a vacuum, and it rarely happens overnight. It happens by repurposing the massive, heavy industrial frameworks we already have in place, quietly retrofitting the old world to build the new one.
Retooling the past for the future.
Exactly. But it does leave us with a significant lingering tension regarding how this all plays out when the rubber finally meets the road.
So what does this all mean for the listener? What's the big takeaway or final thought you want to leave them with based on everything in these sources?
I keep coming back to that idea of corporate sandbagging, and I'll leave you all with this thought to mull over.
Let's hear it.
We know these legacy automotive companies are intentionally downplaying their robotics revenue. They are aiming for just a few $100 million to keep their traditional creditors calm while managing massive debt.
Right, playing it safe.
But consider the alternative. If that downstream ChatGPT moment for humanoids does arrive, and it suddenly spikes global demand into the billions of units, exactly like Elon project.
The total explosion in demand.
Exactly. Will these traditional auto companies actually be prepared to manufacture at that staggering scale? Or will their highly strategic, debt-conscious sandbagging leave them totally caught off guard, scrambling to build the capacity for a revolution they helped design?
That is a fascinating tension to leave on. Are they playing it too safe to actually catch the massive wave they are currently paddling for? Thank you so much for joining us on this deep dive. Keep questioning the world around you, look past the glossy tech PR to see how the world is actually built, and we will catch you next time.